Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, May 19th, 6:25 Mountain Time. I was so excited about the Moody's downgrade that I couldn't sleep past 3:30 this morning. Bit of sarcasm there. Our note was titled Tariff Inflation Mythology. There's two real components of the report. One is to work through the real impacts of tariffs, at least in the April inflation data, which is very much in line with what we've been, telling our readers and clients for months now, which is the impact on growth was likely to be much more significant than the impact on inflation. Walmart's not going to be able to pass through tariff-related tax hikes. The high price elasticity indicates that they'll have to absorb them through margins, and that's what was really evident in last week's inflation data. I'll come back to that shortly. But we wrote a lot about the budget, debt, and deficit outlook. Finished the note, completed it, got it ready to send, went down to the golf course and saw a notification that Moody's was downgrading our credit rating. We remember the S&P event like it was yesterday. It's of little relevance to us, but they're not wrong. Their timing is ridiculous because the problem, it was created several years ago. But nonetheless, here's the framework we want you to think about or one way to think about it at least, when you consider the totality of the policies on the impact of the debt and deficit. So to be clear, the path to stabilization in the bond market runs through one factor and one factor only, and that is spending. Spending is running about $940 billion above its 1981 to 2019 trend, which is 20.3% of GDP. It's on track to be about 23.4% this year, and scheduled to go to 24 through the next 10-year CBO time horizon, forecast time horizon. The reconciliation package as it stands is going to cut spending by about $1.5 trillion over 10 years, or $150 billion per year. The hang up over the weekend, or snag over the weekend, is delaying the spending cuts even further. But let's just call it $150 billion per year. The theoretical tax cuts relative to current law, not current policy, but we'll leave that little notion aside. Income tax cuts for individuals and for corporations, tax incentives, is about $450 billion per year. Now, again, that's a simplifying assumption, but $4.5 trillion over 10 years, $450 billion per year. That should, all things equal, spur more investment. You cut income taxes, you get more investment in the private sector. Not considered as part of the reconciliation bill is about $300 billion in tariff revenues from having a global 10% tariff and something more like 25 or 30% on China. So $450 billion in tax cuts, $300 billion in income tax or consumption tax on imports tax hike. All things equal, you raise taxes on consumption, you get less consumption. This is very much in line with our sector views of being underweight consumer discretionary and staples, and overweight investment beneficiaries, which is a key element to our relatively optimistic equity market outlook over the course of the year, being long industrials, financials, materials, and energy. The net, though, effect is essentially zero on the deficit, right? You cut income taxes by $450 billion, you raise consumption taxes by $300 billion, that's $150 billion of tax expenditures, lower taxes. You cut spending by $150 billion, that's no effect on the deficit. The net aggregate impact of all this, you're cutting spending only by $150 billion, spending is $940 billion above its trend, is negative for the bond market. So we're watching the 30-year TIPS yield, real rate, the part of the curve least impacted by the Fed's balance sheet or rate policy, and that's about a basis point from its all-time high. That security was started in 2004. We're watching swap spreads. We're watching term premiums. We are back in a regime where the bond vigilantes will have the most control over, or is the biggest risk to the equity market right now. So in aggregate, the policy is probably a small net positive for equities, particularly our recovery and capex part of the story. So the sectors that benefit from that, it's a negative for consumption, and it's a negative for the bond market. And that's where we sit from an asset allocation perspective. If you really want the details, become a full paid subscriber. Barry Knapp from Ironsides. Have a good week, everyone.